Hello, everybody. Get this better framed out. All right. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back with more market strategy or targeted market strategy, and how we can use closed-end funds to improve our investing and improve our outcomes. So this is an unedited video, like you just heard. I make mistakes. I like raw video. I don't like fine-tuned edited video. Just it feels very unauthentic to me. I'd much rather be transparent. So who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a financial strategist, really a strategist all around. I don't speak like the herd, as hopefully you can tell at this point. I walk in very limited company, and sometimes I walk alone. So last week, it was an updated video as opposed to the 2 weeks prior that were more warnings about the fear of being sucked into and trapped into the current bond bull push by Bloomberg and the rest. So, where is the market after last week? Not much different. Now, if you really want to boil it down, yes, the market gained, but it really didn't gain much. It's pretty much even keel. So last week finished much the same as how it started. A little movement here and there, but nothing really tipping one side or the next. You've got some company reports coming out next week, but I think those are being pushed or heralded at, and yeah, are they important? Yes, but I think they're almost getting raised up higher than they normally would because there are widespread signals in the economy at large that we're on the edge of a recession. The Fed had rates super high, right? And then once you go from high rates to lower rates, that typically brings on some type of recession. The Fed is, as the head of Morgan Stanley said, the Fed is focused on the labor market and trying to engineer a soft landing. The Fed had rates high because they made them. The Fed printed money, and then to fix their own, to be the solution of the problem they caused, they jacked rates, and then they finally dropped rates 0.5%. Too late because they wanted focus in the current election, but they dropped rates 0.5%. That should have made everybody happy. We should have seen that effects across the board, and that the market at large should have gone up. Bonds, stocks, utilities, real estate, everything should have gone up. And what we saw was mortgage rates going up instead of mortgage rates going down. That's concerning, right? The Fed drops rates. The mortgage rate, the national mortgage rate, is based upon the Fed rate. So if the Fed drops rates, the national mortgage rate should drop, and overall mortgage rates should go up. But we didn't see that. Mortgage rates actually went up. That's alarming because to me, that says there's doubt in the overall market as to how well the current economy is running. We did see an increase in refinance percentage because there are people scared that what the Fed's doing isn't doing enough. So Boeing is currently talking about layoffs. Walgreens is closing stores. And I said it last week. I'll say it again. I will boldly say that if Kamala somehow wins, we'll have a new term for a recession, and it'll be construed as a strong economy. And if Trump wins, we'll have the worst recession ever in recent memory, or at least that's how it'll be spun, right? But Trump's already said we're heading to a recession, as has Jamie Dimon, Robert Kiyosaki, and more, including me. So, recession or not, we still are tasked with managing our money. And if you're like me, you're investing the money. So, we have to exercise caution. We have to be aware of these things and also somehow navigate through them. So, we have to exercise caution. We have to look beyond the current mentality of that FOMO mentality, the fear of missing out. And don't get me wrong, right? The possibility of a recession is still playing into our strategies, but that FOMO, Bloomberg guilt tripping about not investing right now, or at least not investing in what they're telling you to invest right now, is what we really need to avoid. The fear and greed index is finally officially in extreme greed territory. It should have been there a while ago, but we're still on the cusp. I mean, I can show that. I can share my screen. It's been hovering in this almost gray area. I mean, I get the chart is gray, so in this kind of white space between, but we're finally officially in extreme greed. But honestly, we've been there a while. We've been hugging that line for a while. So since we're finally there, even though we've been unofficially there at least the last 2 to 3 weeks, the place to be right now, where Bloomberg and others are telling you to be right now, is bonds and utilities and energy. But that's not where I would invest right now. See, when bonds were the dogs of the market, like 6 months, even, but really 12 months, 18, 24 months ago, when bonds were just where bonds were like the it's like the outhouse of the market where the herd was pushed away from, like nobody wanted to touch bonds. So bonds, utilities, and energy back then 2 years ago, that's when you should have bought those things because they were crazy low, still paying a decent dividend that we all knew would come back and raise, right? But I wouldn't invest into it now because if you buy it now, you're buying into that FOMO mentality. You have these newbies and you have these newbie investors pumping money into the market, jacking the cost of things. So they're buying shares, they're injecting money into the market. The general cost of things is higher. The dividend payouts are lower. That's even the average closed-end fund dividend is down to maybe 7.75, which is still, oh gosh, at least 5 times what you're gonna get out of the S&P 500. But 7.75 is kind of low. I mean, comparatively, we've been running at like 8.5, 9% the last 2 years preceding. So everything's higher right now. I wouldn't buy where everything's higher. And that's not the game to play. So if we're not going to invest in bonds, utilities, and energy, where should we go? Well, you got to think of the current general strategy you're getting out of Bloomberg and the rest. Build a nest egg for that future later date. That's horrible advice. That worked in French Kiss, where she gave her nest egg away to buy somebody else's, what was it, somebody else's diamond so he didn't go to jail or whatever he stole. The nest egg is you save so much money so that you have it for a rainy day. That's part emergency fund, but also so that when you finally retire, you've got this wealth of money in store just waiting to be used. But think about it logically. Let's say you've got 100 grand in the bank. On a good year, you're losing 4% of that to inflation every single year. That 100 grand stays in the bank, but it's being devalued by 4% a year. The bank can actually lend out 7 times worth of your money. So they can lend out your money, unbeknownst to you, and get an incredible return. They're giving you just 0.5%, maybe. I think our bank gives us maybe 0.1% for keeping our money at the bank. I think the best a credit union can do right now is maybe 0.25%. So your 100 grand is making 0.25% a year at a credit union. If it's at a mainstream bank, it's making less, and your bank's making more money on your money than you're making on your money. And it's being devalued by inflation. That makes no sense. You can invest in single stocks, but that's honestly not sustainable. I know a high school kid who's buying partial shares of Nvidia. So he bought shares of Nvidia at 100, he sold it for 150, and then it dropped back down. He bought it at 200, kept it for a little bit, sold it at a higher price, but he's actually losing money every time. And he's only focused on one company. He's focused on the obvious capital gains. He doesn't care about dividends. Nvidia's dividend is paltry. And you also pay capital gains, or I guess his dad pays capital gains on whatever he makes. There's no sustainability there. You have to watch the market like a hawk. And if you're going to buy and sell, like if you're only going to invest in single companies, you're really setting yourself up for a lot of risk. You've got to own, you have to invest a lot, but you also have to own a lot. That's extremely hard to sustain. And the same people that want you to invest in single companies are also telling you to invest in the 4% rule, or at least plan for the 4% rule. That advice is just shitty. The 4% rule stipulates that if you had $1 million invested, that you would withdraw 40,000 annually, or 4%. So 4% of $1 million is 40,000 annually. That's about 3,300 a month. But it's taxed, and you're selling your principal. So it requires that the market goes up at least 8% a year to offset your 4% withdrawal and the 4% general inflation lag. 8% gains I mean, in the history of the market are rare, right? If we look at consecutive 8% gains, maybe you could catch it here and there, but consecutive gains at 8%, that's not something I want to plan on. Plus the 4% rule and the traditional retirement account, all of that's taxed money. I mean, that's great taxed money in the sense of capital gains is not taxed as much as other things per se, pending your tax bracket, but you're losing a lot of money in taxes. And then followed by that 4% rule, the same guys are still trapped inside that 60-40 stock to bond ratio. It's too generic. It's honestly too diversified for me that you have to maintain the metric, or you have to maintain the ratio, and it doesn't allow you to use the existing market for your future benefit. You're trapped in a strategy that's actually strangling your ability to use the current market for future gains. So if we push all of that to the side, and we look not we're looking at the current market, but we're also looking long term. We want to use the current market and closed end funds as we look long terms, because we can pick something we can either buy and hold, or that we can buy and sell, and then we swing that mate that gain, or we push that gain forward. And the goal is to keep the principal intact, unless we're swinging one investment to another, right? But instead of selling our principal, we're actually using our dividends. The principal stays intact, and we're reaping the dividends. The current average closed-end fund, of which, I mean, average is, right, the average of the whole. Some pay none, some pay a lot. The current average is like 7.75. That's a far cry from the traditional 1.3 you make in the S&P 500, and that's a lot more than Nvidia or Apple. So if I invest into just Apple, I get access to just Apple products. Maybe it goes up, maybe not. If it goes up 10% in 5 years, that's a 2% gain a year, and inflation is 4% a year. So I'm losing money there. Their dividend, it sucks. And if their price goes down, well, then I lose money. Same thing with Nvidia, right? But if I could buy a closed-end fund that owned those two and a lot of others, then there's diversity built into the fund, but there's also this, we'll say, the inherent risk goes down, because if Apple and Nvidia go down, other stuff inside the portfolio are going to go up. And instead of getting that 0.5% dividend, I'm getting a 9% dividend, which I said the market average was 7.75. It's like 7.75. Our current average in the individual cash brokerage account is 10%, and our current average in the Roth account is 12. And in the Roth account, it's actually tax-free money. So you put money into a Roth, you're capped, you're limited currently to $7,000 a year. Everything inside the account stays in the account. So if you're swinging money forward, so you buy something, hold it for a little while, sell it, If you're making 300 bucks on it, it stays in the account. You don't pay taxes on it, and you're pushing that money into something else. The dividends stay in the account. They get rolled forward so you can buy other stuff. So it's not a straight compounding interest system, but it's very similar. So in a Roth account, whenever you retire or whenever you jump through the hoops, whenever you hit the age and you take money out, it's not taxable income. So you, let's say you have that $1 million and you're still taking out 4% a year or 40 grand a year. So about 3,300 a month. When you take that 3,300 out a month, it's tax-free income, tax-free withdrawal. Gets notated on your taxes where it comes from, but there's no tax related to it. That's a lot different than taking the same amount of money out of your IRA or anywhere else. So our goal is we keep the principal intact and we either live off dividends or we supplement our retirement on dividends, right? So if we factor all of that into our strategy, I mean, the Roth is there. We have the brokerage account. I talk about this on videos too. But if we look at the overall current strategy, right, and I'll go back, we're not slocking money into a bank. We're not looking at single stocks. We're not playing into the fear of missing out on bonds and utilities and energy. If we're looking at the current market at the best place for the current market and the best place going forward, that really just leaves us with one option, right? So in interest rate land, when interest rates go down, everything in theory should go up. Mortgage rates, for whatever reason, haven't. I think that's an underlying fear of how the economy really sits. But in recession, whether it gets labeled that way or not, in a recession, stock prices go down, bond prices go up. Energy, utilities, we'll see how it goes. It might go either way. But the best place that leaves us is real estate. Real estate hedges us in high interest rates. It hedges us in low interest rates. And when it's fluctuating like it is now, that's a good place to be looking forward. It's hard to apply yesterday's strategy or the strategy of 2 years ago, buying bonds, energy, and bonds, energy, and utilities, right? It's hard to apply yesterday's strategy to where you should be in the market today or tomorrow, I guess, at opening bell. That's a losing situation. So instead of getting sucked into the buying of now, right, or that fear of missing out and paying a higher cost and getting a lower dividend, like what those talk show idiots are telling you to do, let's avoid the noise and look far beyond where the herd is currently being guided. So mortgage rates went up, right, after the rate drop. That's kind of weird. CNBC spins it this way. And this is their quote off their editorial. The recent rise in mortgage rates may have slowed the resurgence in refinancing, but home buyers may be less concerned about interest rates today and more concerned about the shape of the economy in the coming months. Some say they're holding off on making such a major purchase until after the November election. The election is a bigger deal than most people want to admit. You've got two very different people, two very different plans for America. Trump is pro-America. Kamala is anti-America. If we all stand on the edge of a knife, right, we are. If we're positioned on the edge of a knife, the election outcome will either turn the blade, scary, it will either turn the blade or it's going to slice us into bits, and nobody wants to get cut. So regardless of the POTUS winner, there's still one investment location we should consider right now, especially as the herd continues to be pushed, driven, and guilt-tripped into investing into these other things late in the game. And whether you like it or not, and I certainly don't like illegal immigration anywhere, that massive influx of people causes the cost of everything to go up, especially housing. I mean, it's the supply and demand side of things, right? There's limited supply in general based upon past months' data, but then you have a swell of people coming in, regardless of method or legality. You have the swell of people coming in competing for the same things. So the groceries are up, housing is up, gas is up, all the stuff is up, right? For lots of different reasons, but that's playing into it. But we see it a lot more in housing, right? Housing is needed now, and it will be needed in the future. And it's going to be one of those things that it's cyclical in nature to a degree, but we're not near where we need to be in the catch-up phase of things. Housing is kind of the in that circle paradigm is, hey, it's needed. Great, we'll start building. At some point, they come available. More people find housing. And as the circle spins, sometimes it spins faster, like you need housing sooner than later. And sometimes it spins slower. Housing is not in high of demand right now. And right now, housing is huge. And that's any housing. You've got apartments, single family home, multifamily unit. Across the sphere of housing, we need housing. And for whatever reason, there are there are funds in the current market that focus on real estate that are just dogs of the market. And I think they demand our attention. So let's look at the closed-end fund list for the week, and I'll show you what I mean. I mean, honestly, if you watched my video last week, you've already seen a lot of this. But this is the new data. So this is the closed-end fund master. And these targets over here are outlined here. So one, we track for any number of reasons. Two is a dollar cost average alert based on what we already own. And three is a buy alert because the current discount is both double the historical discount as well as greater than the 5-year discount. And if it's a newer fund, there's a little leeway in that. Like there's a 3-year-old utility fund that has close to the same discount that's on the list. There's a relatively new bond fund uh, that doesn't quite meet that triple asterisk parameter, but it's on the list because it's a new bond fund. So of this list, the entire list of 410 gets updated every month, generally at the beginning of the next month. And then purple, which is recommended, dark blue we own, green we watch, light blue we own. Those get updated weekly. So to make it make sense, I mean, there's a lot of data. You could scale it, I guess, any number of ways, but I look at the overall discount. We could get trapped in yield, but I like to use that secondarily or tertiary. So we look at discount and then we scale by target. And then of all the different targets, I mean, singles, interesting, dollar cost, right? The ones we care about are these because these are the best deals. We have what we're targeting. In months past, weeks past, we're looking at bonds, high fixed income, stocks and tech, depending. Right now, this is what we're focused on. So we want consistent monthly payers, which means even though this, I mean, it is a real estate fund, and it traditionally stocked with preferred shares. So in a recession, they're going to get paid. But I like consistent monthly paying. So those get next. So they're all targets, right? They're all significant discounts. They're all, well, so they're all targets here. They're all targets because of the significant discounts there. So we can actually look at yields. And we can also look at what kind of fund they are. So as we go through, we're looking at real estate, right? Maybe I could make a secondary consideration based on a specific fund. I mean, if you, so real estate, I would not get into I would not get into stocks. I would not get into tech. Bonds are the current crave or current craze, as are uh, energy and utilities. But if you could find bonds, energy, or utilities exceptionally cheap comparatively, I guess you could make a good secondary offer for that, but we'll get to that. So muni bonds, utility, that's like if you're late to the utility game and you still want a utility, you could make an option for the, or I guess you could make a, can't think of the word. You can make an argument. There we go for this company. So based on the data, so I'll scroll it over so you can compare. Historically, a fund with no discount. The 5-year average is pretty much close to zero. The current discount is almost 13 cents off or 13% off. So if we're looking at a dollar invested, so a dollar would be pretty much break even. Like for every dollar in, you're in, or for every dollar invested, you're spending a dollar. This is like getting it for 13 cents off. So you're, instead of spending the dollar, you're spending 87 cents. Right? And it's all utilities. So if you wanted a utility investment, I could argue for that. But that's not us. It's still higher than what you'd be paying 6 months to 2 years ago. So municipal bonds, stocks and bonds, that's all real estate. Um, TEEF is TEEF doesn't make sense to me. I know it makes sense to somebody, but TEEF is an investment into every type of renewable energy, but not oil. Because to them, oil is not renewable, but all of those forms of renewable energy are dependent upon oil to be made and to run and to do maintenance. So they'll actually, I mean, wind farms, all of that requires oil to make and oil to maintain. And when the blades break, they don't get recycled. They get buried in a special plot of land. Solar power takes oil to run. Water power, yes, is generated by water, but you have to have all lubricated parts, and it takes oil in order to make it. So the renewable energy will eventually break, needing more oil to replace the parts that break, and oil derivatives in order to be installed. So why not just invest in oil? Well, oil is bad, but that doesn't fit into your moniker. That doesn't make sense to me. This is all stocks. This is all stocks. That's all stocks. All stocks. Tech stocks, but all stocks. Utility. And I've met somebody that owns this, but if you buy it, you're paying so much more for it now. Yes, it throws a great dividend, but you're paying so much more for it now. We own the stuff in dark blue. So this is a great high fixed income corporate bond fund. Same thing. That's a mix of bonds and energy, utilities. Uh, that's another great bond fund. But if I'm being extremely choosy, and I am hyper focusing on real estate, and I am, it really only leaves one investment. Now you can make a counter argument for utilities. I don't know about that utility because it is considerably higher than what it used to be. You could make an argument for these bond funds. Um, and I'm not superstitious, but I'm not buying this fund at that price. But you could make an argument for a utility investment, but that's not me. If so, I'm hyper focusing on real estate. I'm hyper focusing on the best deal on the present board, and that's this. So let me stop the share for a second. Uh, of the only of all the different market subscription services, I only pay for the Contrarian Outlook, and because I found it on a paid for article. I'm not going to show you exactly what it says, but I will read it. Uh, so in January of this year, HFRO share price dropped for a couple reasons. Really, I'll say at least three reasons. So they cut their dividend. That makes people cautious. Uh, they became hyper focused, I guess you could say, in their own internal investment, which I'll get to in what I say in this quote I read. But they also switched from a bond fund to a real estate fund, and they haven't really explained why. And that made people concerned. So they switched. They were a hedge fund bond fund and paid an outstanding dividend. And they switched that strategy and went all in on real estate. And nobody understands why. Or at least they haven't explained why. And then they invested a lot into their own internal real estate management. That made people a little more cautious. And then they also cut the dividend because the existing dividend was not sustainable in the current market. And in response, their share prices dropped, which I'll get to. But I'm going to read this first. So, the reasons for the ongoing discount. This is from Michael Foster, who writes for the Contrarian Outlook. And he said it back in March, so about 7 months ago. The reasons for the ongoing discount boils down to concerns about the portfolio's quality and management. HFRO invests heavily into assets issued by NextPoint, including NextPoint Real Estate Finance, which is the same family as HFRO's management firm, NextPoint Asset Management. And that's made some investors uncomfortable, prompting them to look into other options. That being said, how big can a discount get? 50% write-downs when the fund's assets are recovering strongly from both the pandemic and the 22 meltdown suggest that HFRO could be way oversold despite the lack of diversification inside its portfolio. So back in March, it was about 50% off. The fund's assets were recovering and doing exceptionally well. They were recovering from the pandemic. They were recovering from that 2022 weird stitch. And despite those things, the portfolio was doing well, meaning maybe the fears were oversold. But not much has changed in the last 7 months. And the best way I can explain it, and I'll say more, is if we look at the cost chart, it's like a confidence meter. They restructured the portfolio. I don't know why. And I don't know if I need to know why, but it would certainly make me feel better to know why, as it would other investors. I don't know why they went from bonds to all in on real estate, but surely they had a reason. And in that restructure, they bought into property. So they bought single family homes and multifamily units. They bought hospital stuff and this stuff and that stuff. They bought into properties that were not yet online and operational. They were in construction. So since they were not operational, they're not making money on that square footage. Now it positions them well in the coming market. So it positions them well for when the Fed cuts rates. It positions them well because all of those things are highly needed. So when they come online, they're sure to be rented out. Right? And more square footage online, more square footage online and running equals more rent money. And more rentals, more working rentals, or more occupied rentals equals a rising net asset value and eventually a rising dividend. But how long can the crazy discount last? I don't know. But quite honestly, I'm game to profit off somebody else's fears. And this is what I mean by that. I'm going to share my screen again. Everybody can find this website. CEF Connect has every closed-end fund except for two, the SABA funds, SABA outright, and then BRW, because I think they're pissed that the guy who owns those two is really taking it to the closed-end fund market and making it making it an improved shareholder experience. but that's on the that's on the odd political, it's on the oddly political side of closed-end funds. So if we look at HFRO back from the beginning of this year, so right about here, that's when they cut the dividend and they announced the restructure. Chances are it was happening before that, but that's when they announced it. So since they announced it, share price has dropped. But if you look at the actual value of the actual value of the company is slowly increasing. Now, it's not quite what it was when they were a bond hedge fund pre-pandemic, but it is slowly getting back up. And as more of it comes online, this light blue line will continue to rise. But since everybody, maybe not everybody, since a ton of people are really concerned that they switched from bonds to real estate and haven't explained that, and that they're hyper focused internally, which you can see more of their portfolio on Morningstar. This is like a surface view of their portfolio back from June. Morningstar has a slightly more accurate current view, and then if you really want the data, you can easily find their portfolio online. I love how transparent that company is. I mean, we own it, but I love how transparent the company is because they'll tell you everything they own and how it's broken down inside the company. They're they're highly invested into their own, I guess, inside their own company, but they are invested into other things. But if we look at this, so that they're recovering and the value of their portfolio goes up, and for whatever reason, people just haven't cottoned on to that. And honestly, I can't explain it. But I'm happy to profit off somebody else's fears. And that's kind of the same thing with the herd in general. The herd is being pushed, guided, steered, pushed into bonds, utilities, and energy. And that's great because honestly, I mean, if we're going to play the overall game, we didn't invest in utilities, but we invested in the other thing. We invested into bonds and in energy transfer, just energy in general. So we invested into those things, and the media pushing the herd into those things is just raising our profits. I have funds that are earmarked for sale. I have long-term investments that are earmarked for sale at certain price points. I mean, the end goal was to ditch the individual brokerage account where we're paying taxes on and reinvest that money into the Roth where we will not be paying taxes on. So it's quite fine by me for the herd to be pushed into these things because we're already invested. We bought them cheap. They pay great dividends, right? Those share prices will elevate. And if we're lucky, we'll sell them when they're high. I mean, perfectly fine. But the other part of the game is while the herd is being pushed into those things, I want to look at the market where the herd is not, so that I can invest early when for whatever reason the herd won't go near them, whether they're scared of it, whether their handlers on TV are like, no, that's not the thing. Bonds are the thing now, right? Or those other investors, whatever reason they're scared, that's what I look for. Because if I could find a dog, just like an outhouse of the market, that still pays a decent dividend, that paid an amazing dividend, that dropped, shareholders are unhappy because it's discounted so long, that's positioned well to swing up again, right? And pay an amazing dividend going forward. That's what I want to find. Because if I can find it cheap now, either A, I can swing it, right? I can find it cheap and collect the dividend. Hopefully the dividend will come back and I can either ride the roller coaster when it's high and keep it when it drops back and buy more of it cheap, or I can swing it forward. I can buy it low, wait for it to come back high, reach a specific height, sell it, take the profit, and push the money forward. And so long as I do it inside our Roth account, no taxes. There's no capital gains taxes on sales. There's no capital gain. There's no income tax when we withdraw, so long as you jump through the hoops. So you are only limited to $7,000 a year. But if you do your investments right and make money off of them, you're making more than 7 grand a year. Like you're putting in 7 grand and then you're getting in dividends and the perks of selling well-picked companies inside your account that just help you grow your money faster. So I know that's a lot for a regular video. And the best way I can sum it up is the easiest place to be is where the herd is because everybody talks about it. Maybe not everybody, right? I try to stay away from the herd, but where the news and the hype and the loudest noise is coming from, that's where the herd is being steered. Individual stocks, tech, AI is up and down, but really it's bonds, energy, and utilities. That's the push for the herd right now. If you listen for that, you'll know where they're going. But the key is to get into the next thing before they get the signal that they should be somewhere else. Right. And then you either sell your stuff when it's high and thank the herd, or you keep it and see how it goes. Right. And you just collect the fat dividends as you go. So it's all I got really. It's where the herd is not right now is real estate. And that's worth a look. For us, our goal is after we finish that transference of money, so take money out of the individual brokerage account, withdraw it. Interesting lizard on the window, sorry. So we take it's not a straight account to account transfer. So it's withdrawing out of one, drops into your bank account finally, uploading into the other, finally settles in that new account. In that process, I want to pick up 100 shares of HFRO unless something crazy happens between now and the day we buy it. But I also don't want to spend all the money that we have loading into the account because I would like to invest for sure either in the next month or December. And not many people invest in the later months. They just don't for whatever reason. So if we can still scoop a great deal on real estate, or if something else comes available, if we like OXLC specializes in loans and it typically runs at premium. Our real estate RFI does as well. If either of those dropped into significant discount in the next 2 months for any number of reasons, it's like if OXLC, if I woke up tomorrow and OXLC was at a discount, even if it was at a 0.5% discount, that doesn't happen very often. That would be worth a buy. So I want to keep money on hand in case an amazing deal comes along. But honestly, HFRO in and of itself at 54% off is an amazing deal. I mean, think of that. Instead of paying $1 and that dollar investment, 54% off, you're paying 46 cents on the dollar for every dollar invested. That's obscenely cheap. And it's a great real estate company with more product coming online. So it's worth a look. It's definitely worth buying another 100 set from us. Yeah, and then we'll see what else happens on the rest of the week. So wherever your financial destination lies, this is kind of my normal closing, which I guess I should say, if you like my content, consider subscribing to the channel, hit the like button, share the video with other people. I mean, yes, improve your own investing, but also help somebody else out. Closed-end funds, for whatever reason, are not well known, but I mean, Morgan Stanley, Warren Buffett, Taylor Swift. There are a lot of people that invest into closed-end funds and don't tell people about it. So share something good with somebody else. But wherever your financial destination lies, you're not going to reach that place without knowing why you're going or why you're even trying to get somewhere else than that 65 plus year retirement plan that your company has. Meaning, if you look at the traditional financial map, and if we lay it out like a Sesame Street pirate map, you have the boat of where you are, you have Treasure Island, and X marks the spot, and that's where the journey ends. First, that's a pretty flawed financial map because it leaves no room for life after you find the treasure. Second, I mean, it's a one-dimensional schematic of something that is not going to be a straight line. Okay. Third, if you have no idea why you're doing it, it's really hard to go to the island. It's one thing to go to the island for a giant box of treasure. It's another thing to go to the island because you think treasure is on the island. Just means you like the adventure and not so much the destination, right? Anything could be on the island. You could open up the chest and it would be two coconuts, and you'd be like, oh my gosh, it was such a great journey. But you could have spent time looking for treasure. But adventure is the treasure. That's not what I'm talking about at all. Fun times, but not purposeful financial investment, right? If you are wherever you are on that map and you're trying to get to that treasure chest of actual treasure where you can beat the general rigmarole of our lives, or you can retire earlier than 65, or whatever it is that you're going to do, if you have no idea why you're going to the island, it won't be important to you. But if you have no plan to live past the island, now you have no opportunity to enjoy what you find on the island, right? The journey does not end on the island. The journey is instead one spot on your map. Like if we're looking at a waypoint system, from waypoint to waypoint, your island exists on the map, but your journey continues forward. Does that make sense? I hope it does, because if you get to the island and you don't find the treasure, or if you have no plans for after the island, it's really hard to leave the island, right? In the course of your financial plans, of wherever you are to wherever you want to be, your dreams will not happen on their own. It's not something that will just randomly occur happenstance. Instead, you actively have to captain your ship. You direct its course, right? Which is why it's so important that you know where you're going and why, right? But your dreams will not happen without purpose. You have to make them happen. You have to want them to happen, but you have to make them happen. You have to want to be on the island and find the treasure so that you can enjoy the treasure after the island with the rest of your life. And if all of that makes complete, total nonsense after a closed in fun video, then come find me on Facebook. And honestly, pretty soon I'll be pretty soon on Instagram. My goal is to move my Facebook pages to Instagram and combine what I'm doing financially on Facebook into one place. It's convoluted, but such is the state of things. So currently you can find me on Facebook at the Navigate Your Finances page. Currently, as well as of November 1st, the Navigate Your Finances page will operate off of Instagram. And just like this channel on YouTube is the Adapted Perspective channel. On Instagram, it will be Adapted Perspective. On Pinterest, it's the same thing. I have pages on Facebook that share a name, but instead of really all of that challenging stuff, I want to simplify things onto Instagram. It's just Adapted Perspective. Have this channel, have Pinterest, and hopefully a more streamlined effort. So if none of this makes sense, for right now, you can find me on Facebook at Adapted Perspective Navigate Your Finances. But pretty soon you'll find me on Instagram instead at just Adapt Your Perspective. So whatever you have, whatever your plans, whatever your hopes for the market or your dreams for life, or that overall grand scheme financial picture you have for your life, it will not happen on its own. So make it happen. And I will see y'all on another video. Hope you have a great week. Bye-bye.